So let's talk a little bit about the economy, where we're at year to date. What has changed in the last 6 months? This is the picture of the leading economic indicators back in January of this year. The things that were trending very positive at the beginning of the year, if you look at the left side, were things like monetary policy, the labor market, the business outlook, inflation, consumer spending, consumer sentiment. Things were looking pretty good at the beginning of the year. Not too much in the red. Generally, geopolitical risk is always red. It's been red ever since Russia invaded Ukraine, and it continues to stay red. But overall, the financial and economic markets didn't look too bad off from a forecasting standpoint. Now let's look at July, where we're at today. You can see a lot of the green disappeared. And what's behind this is primarily a lot of the uncertainty that has entered into the economy and the markets, the biggest driver being the tariff announcements in April. And we saw the markets react to that and staged a comeback since then. But as you can see, most of the dials that were green are now yellow. Again, yellow does not mean necessarily bad. It's just saying that there's not a positive or negative trend moving forward. One of the things I want to point out is, what is the Fed going to do with monetary policy? And as you can see in this chart, the black line starting on the left, that's rising up. We actually had zero interest rates back a few years ago. Inflation kicked in. The Fed started raising interest rates to counter that. And you can see it kind of leveled off in that 5.25, 5.5 range. And since then, it's come down a little bit. The Feds did lower at the end of 2024 the overnight rates, but they leveled off again back in that 4.5% range, and that's about where we're sitting now. So the concern is, with the economy slowing, with all the yellow dials we just looked at, not a lot of positive trends right now. What should the Fed be doing? And this red line represents the direction that the markets are believing the Fed is going to do. They're looking for some rate cuts before the end of this year, much more next year as the economy continues to slow and bottom out, and then possibly move forward from there. So right now, from an economic position, the Fed is being restrictive as far as the way they're managing the federal funds rates, and we're expecting some easing there moving forward. A recap of some of our major headlines of different economic things that we track. If you look at the top line here, real annual GDP growth, you can see that the U.S. grew at a rate of about 2.5% in 2024. Our consensus, if you go all the way across to the right, is that we're expecting 2025 to come in at about 1.4%. So City National Rockdale's gauge is between 1 and 1.75%. But what we're saying is that growth is slowing, and we're expecting it to come in slower this year than last year. Let's look at the next line, corporate profit growth. Last year, the S&P 500 average corporate profit growth was about 9.6%. Very good growth over 2023. We're expecting that to be down a little bit this year. The consensus is at about 7.5%. So that isn't as much growth in profits this year as last. However, that's still healthy profit growth. I mean, this isn't just profits, it's growth over profits over 2024. Next line, the headline CPI year end, that's the consumer price index, or the measure of inflation. That came in at about 2.9% in 2024. Still not at what the Fed would like to see at 2.5%, but it is down considerably from a year ago. And also, we're expecting that to pretty much flatten out, stay where it's at, or maybe due to this tariffs, maybe be right around 3%. So not really going down, possibly ticking up a little bit. But overall, I think it's in line if we look at historic inflation rates. Then the bottom two, the federal funds rate, which is between 4.25% and 4.5% at the end of last year. We expect that to drop somewhere in the range of around 4%. We expect 2 cuts by the Fed before the end of the year, quarter point cuts. And finally, when you look at the Treasury notes, the 10-year ended the year with a yield of about 4.75. We still see that coming down a little bit more and being around 4.25, which in the long-term historical rate for a 10-year is about normal to be 3.5%, 4.5% range moving forward.